understanding your finance condition when purchasing property in New Zealand. Hi, I'm Tracie Griffin, and this video is an introduction to obtaining finance for the purchase of a standard New Zealand property. There are 4 steps to financing the purchase of a typical New Zealand property. Step 1, the bank likes you as a potential client. Step 2, the bank approves of the property that you wish to buy. Step 3, an insurance company is willing to insure the entire home in full. Step 4, you receive final written approval for your loan. You must have this letter of offer in writing, because if you don't, you'll run the risk of losing your deposit, getting fined, and even being sued for damages. Now, let's dive a little deeper into each of these steps. So step 1, the bank likes you as a potential client. Just so you know, a pre-approval letter is not confirmation of a loan. It's confirmation that the bank thinks you might make a good investment partner. If you haven't done so already, you'll need to apply for a loan. You can register with either an independent broker or a bank broker, also known as a lending officer. It is my opinion that a good independent broker offers you the chance to get a better rate, have a better experience, and have fewer complications throughout your transactions. Because knowledge is power, and choosing an experienced broker can make all the difference. So either way, you'll need to supply your broker or your lending officer with your financial information. So they will evaluate your character, so who you are, how long you've been in your industry, and what your credit history looks like, etc. The lender will calculate your cash contribution towards the purchase and assess your ability to service the loan in the event that interest rates go up. After the analysis, you'll hopefully receive what is called a pre-approval letter from at least one lender. Read it carefully. The devil is in the detail here. It does not say, go out and buy whatever you want up to a certain amount. It says, we think we might be able to offer you a mortgage under certain conditions. You do not have finance yet, and you should therefore make sure your lawyer reviews the agreement before you sign it. Lawyers are fantastic at ensuring agreements provide enough time to satisfy lenders' demands, particularly in the event of using money from another source, such as a KiwiSaver or a first home grant. So they will advise what circumstances you'll be able to exit the contract. And remember, you risk losing the property and possibly even your deposit if you make a mistake with your finance clause. You can be heavily fined and further sued for financial loss by the vendor if you fail to uphold your side of the agreement. Which brings us to step 2. So your lender must approve of the property itself. Think of your lender as your new business partner. They will decide if the investment is worth the risk, and therefore they must have evidence that both you and the property meet their full lending criteria. Some of the things that your lender might ask for will cost money up front. You'll need to have some cash put aside for the cost of these expenses, as well as the cost of the transaction itself. Your lawyer's fees for things like a new build or KiwiSaver and government grants, they can really add up. And this money is exclusive of your cash contribution towards the property. So before I launch into things your lender might require, you need to know 2 things. First, the sooner you engage a lawyer, the better. Law firms are now governed by both the Law Society and the Department of Internal Affairs. You'll be required to verify your identity, where you live, and where your money comes from. Now, this can be quick and easy, but it can also be very challenging. So you don't want to be doing that at the same time as trying to sort out your finance. So it's called AML-CFT, and it stands for Anti-Money Laundering and Countering the Financing of Terrorism. Most firms call it AML for short. Call your lawyer to find out about their processes for both engaging the firm to represent you and AML so that you can get both of those parts out of the way early. The second thing you need to know is that you'll have to pay your lawyer's fees before the settlement date. The financial definition of a settlement is getting your balance down to zero, nothing owing and nothing owed. So if you've been told that your lender is offering you a cash back to help you offset your legal fees, think again. Cashbacks only occur 1 to 10 days after settlement, so not helpful towards your fees due on settlement. So if your fees are not paid, your settlement will default and you will be held financially responsible. Now, getting back to your lender, here are 13 of the many things they may demand, depending on your risk profile. Number 1, the title and any instruments on the title. An instrument is the associated document relating to any numbers listed on the title. Your lawyer will send you a copy of each one. However, if there's an encumbrance, a caveat, a resident society, or any other priority on the title, your lender may require extra time to have their own legal team review it. Each of these items poses a threat to the priority of their mortgage over the property, and thus they take them very seriously. So, number 2, a registered valuation. This report will generally cost you around $700 in Auckland, and you'll need to pay for it up front. You can contact your own valuer, or sometimes your lender will book one for you and you'll receive a link to organize payment. Think of this report as the lender's way of making absolutely sure that you aren't offering to pay too much for the property. If the valuation comes in way under the price you offered, they'll want to know why, and it could affect their decision to lend you money for that particular property. So, number 3, a toxicology report. Now, although this is often contentious, your lender has a right to be confident that their investment has not been contaminated by toxic substances. You'll need to pay up front, and depending on the size of the home, this can be expensive. I've heard of instances where a very minute reading in one room prompted the request for every room in the entire home to get tested. And this could blow the average budget in a lot of cases, and it has triggered both renegotiations and canceled contracts, despite the fact that the level was barely a trace amount. Number 4, a building report. Again, this is something you'll need to pay for upfront. It's important to note that even if the lender doesn't require a building report, you may still wish to have one for your own peace of mind. Recently, this clause has been changed in the sale and purchase agreement to protect vendors from buyers wanting to exit on this contract in the clause. This clause in the contract. It is now required that a building report be done by an experienced professional, and they must yield a professional report, generally including photographic evidence with clearly written descriptions of the inspection, or the findings can be completely contested or even outright rejected. That means that you cannot use this clause to legally exit the contract if you did not use a professional building inspector and provide the vendor with a copy of the report. Another important note is that some real estate agents actually change this clause in the further terms of sale section, indicating that their client has a right to remedy. Now, this means that you may not be able to use this clause to exit the contract at all. So the vendor can fix or remedy any issue found and stop you from exiting the contract. The quality of the work will generally be to the vendor's standard, not yours. So this risk is best mitigated by having your lawyer review the agreement before you sign it to ensure you fully understand the associated risks. Number 5, a limb report. LIM stands for Land Information Memorandum. And this report should always be ordered in the full names of all the purchasers. Because here's the thing. A LIM is like a promise in time from the council that the property you want to buy is what you think it is, and that it's also surrounded by what you think it will be in future. So if the council changes their position 5 months or 5 years down the track, and your property value is negatively affected, you can take that LIM report with your name on it and potentially argue for compensation. If, however, you choose to accept a LIM report from a vendor, then you will not be able to use that document in any council issues because your name's not on it. I've told many purchasers in the past to put as many names on the report as possible, including the children. You don't know how long the house will be in the family, and it can't hurt to be cautious. The other reason for a LIM is to find out, is it a wind zone, a sea spray zone, a slip zone, a flood zone, etc. What exactly is the land zoned for? Are there any rates owing on the property? And are there any regulatory notices outstanding? If there is a house or a building on the land, then the LIM will help you assess if there are any unpermitted works that your lender will not like. The LIM should also show things around the property, such as protected areas, and perhaps if there's any plans to, say, put up a giant mall across the street, or an airport in an airport runway in your backyard. You'll need to read the LIM report carefully and compare what it says about the property with what your own eyes see on the property. Are there any extra buildings or additions not consented on the LIM? The cost of a LIM varies to the regional council which produces it and how quickly you need it. So you can often pay more for an urgent LIM if you require one. Number 6, an insurance quote. Now, if you're purchasing a body corporate, basic insurance should already be taken care of. But if you're buying a house, this one is make or break. Here is the very real danger of losing your deposit. All loans require proof of insurance in the form of a certificate of currency, also called an insurance certificate. However, you can't get this certificate until you pay for the insurance, and you can't pay for the insurance until after you've satisfied all your conditions, and the agreement has been declared unconditional, also called sold. But lenders will give you a letter telling you that you can go unconditional and purchase the house as long as you send that certificate of currency sometime before settlement. The issue here is that a very small number of people are sometimes denied insurance for a range of reasons. The property could be blacklisted as high risk. There could be something unpermitted that the lender has accepted, but the insurance company will not. Or one of the applicants could be denied based on the character requirements. So if you declare the finance clause satisfied and then you can't get insurance, you'll not be able to draw down your loan on settlement and you'll lose your deposit. So this is easily avoided simply by contacting an insurance company, disclosing any and all issues, and confirming their willingness to offer you complete unconditional insurance before you satisfy your finance clause. A simple quote, that's all it takes. Now, number 7, disclosure statements. So if you're purchasing a unit title with a body corporate, your lender will ask for the pre-contract disclosure statements with minutes. Now, Clause 8 of your sales and purchase agreement states that the vendor must supply at the vendor's cost. However, your lender can request at your cost an additional disclosure statement showing various records on maintenance, finances, insurance, contracting, and governance, etc. Unfortunately, this can take more time and cost you more money, but your lender has a right to dig a little deeper into the property's history. Number 8, leases. So if you're purchasing a cross-lease title, your lender will most likely ask for a copy of both the leases for both titles. Ideally, the leases have identical clauses. However, there are many instances in New Zealand where they don't match, and the risk has to be further evaluated. And now this can take extra time, and your lawyer will be able to charge you for that extra time, as this falls outside the scope of a normal transaction. So be sure to clarify additional fees in advance and evaluate whether this extra cost will be worth the overall property investment. Sometimes things get sorted really fast and there's no fuss, but other times purchasers choose to renegotiate the buy price, or they may choose to throw in the towel and exit the contract altogether. Title issues are like fingerprints. There are no two alike. Number 9, proof of the right to buy in New Zealand. So all purchasers must be able to prove that they have a right to buy property or even transfer property from one name or entity to another. Your lender will need this proof from everyone named in the purchase. So the Overseas Investment Office is the monitoring body for this restriction. And if you need to apply for approval, let everyone know and be sure to give yourself enough time in the contract to allow for the application to be processed. Ask your lawyer if you have any questions. Number 10, a tenancy agreement. So if your purchase is an investment or there is a fixed term tenancy, your lender may ask for a copy of the tenancy agreement. The agent can supply a redacted version to you, your lawyer, your broker, or your lender. Now, although the agreement does display the tenant's name and rent payable, the tenancy agreement contains confidential details of everyone living in the home, and thus a redaction is important until after the contract becomes unconditional. Number 11, a rental assessment. If it's an investment, the lender can ask for an agency rental assessment to give them an assurance of the expected income the property should be able to generate. So please note that agencies do not guarantee what's achievable. Number 12, KiwiSaver. If you've told your lender that you'll be using a KiwiSaver, you'll need to provide proof of eligibility from KiwiSaver. This is a very important lender's condition if you've planned to use KiwiSaver. So your lender will stipulate in the fine print of your offer of finance, that you must be able to access your KiwiSaver in order to draw down the full loan on settlement date. So this is your responsibility to ensure your lawyer has submitted the application and that you have given everything that your KiwiSaver provider has requested in order to process your application. So once it's processed, you'll receive a letter of eligibility that will also give a value and the letter needs to be given to both the lender and the lawyer. As a side note, KiwiSaver applications require more time from your lawyer, and thus they will charge accordingly. Ask in advance when shopping for a lawyer, and remember, often in life, you get what you pay for. So, number 13, Home Start Grant. If you're using a government grant, such as a first home buyer's grant, the same thing applies as a KiwiSaver. However, there's more to it. These grants actually have a 3-stage process. So it takes longer. You should complete the first stage application before you even make an offer on a property, if you will be depending on that money. So that's it. These 13 items are the most common things that lenders ask for, but bear in mind that there could be others. Each item has the potential to delay or decline your finance application, so be as prepared as possible. So, in review, there are 4 steps to finance. Step 1, the bank likes you as a client. Step 2, the bank approves of the property. Step 3, an insurance company is willing to insure the property in full. And step 4, your lender makes a final letter of offer in writing. Here's a warning that I hope you will heed. If your bank's offer is not in writing, then it simply never happened. And if you act without a written offer, then you alone will face the consequences. You can lose your deposit, get fined, and get sued for financial loss and legal fees. That's my warning. Now, remember, if you do manage to get a letter of offer in writing, then there is one other risk that you could face, and that's if you don't read it. Read it and fully understand the fine print in the letter of offer from your lender before you satisfy your finance clause. The reason I say that is because almost all letters have some conditions. As I mentioned above, one of those conditions is an insurance certificate before the money can be drawn down. And you'll need to check that you can get insurance first, but only after unconditional date can you get the actual insurance certificate. So no certificate, no money, no exceptions. So it's always a great idea to make absolutely sure that you can get that full insurance prior to satisfying your finance condition in the agreement. And remember, insurance is included in body corporate fees when you're buying a unit title. So you don't need to sort finance when purchasing a body corporate unit title. Okay, before I sign off, please note that I am not a lawyer. I could be wrong about anything here. So check, recheck, and ask your lawyer for confirmation about anything and everything. The other thing you need to know is that there are always things changing. Laws, regulations, legal procedures, contracts, and more. So stay on your toes and confirm everything with a trusted source. Read everything and discuss it with your conveyancing lawyer. They usually know their stuff. When it comes to transacting property in New Zealand, timing, variables, and the sequence of events are extremely important. Even the most experienced conveyancing lawyers can be challenged by the demands of lenders. Here's something you may not know. Lawyers act for the banks as well as you. So it's your law firm that makes promises to the lender by signing a document called a solicitor's certificate. And your lawyer must promise that certain things have been done before any money can be drawn down. And the penalty for error here is catastrophic for the law firm. So don't expect any exceptions in the area of finance. Thanks for watching, and I hope this general information helps you better interact with your lawyer and your lender.